Silver didn't move because demand surprised the market. It moved because nearly 1/3 of the paper silver market quietly exited in less than 2 weeks. And if you're still waiting for a bullish headline to explain it, you're not just late. You're standing inside an illusion that was designed to keep you calm while the system resets against you. This is not a rally. This is not volatility. This is not speculation. This is a controlled mechanism breaking in real time. For years, the financial establishment, banks, exchanges, regulators told you silver was abundant, liquid, well supplied. They repeated it while paper contracts multiplied, while rehypothecation turned a single ounce into 50, sometimes 100 paper claims, while Comex price discovery drifted further away from physical reality. That was not a mistake. That was design. And now the design is failing. Over the last 7 trading sessions, silver advanced while open interest contracted by roughly 8 to 12%. Physical premiums stopped compressing after months of forced decline, and implied volatility remained nearly 6% below its 30-day average. Those numbers do not belong to a healthy, transparent market. They belong to a market where participants are quietly pulling out before the door narrows. This is how controlled systems end, not with a crash, with exits. Liquidity vanished first, not in headlines, not in speeches, but in the order book. Sell-side depth thinned by approximately 10 to 13%, rollover behavior changed, and price stopped responding to pressure that would have crushed it just weeks earlier. This is the first sign every forensic analyst looks for. When selling no longer works, control is slipping. Then positioning cracked. Rising price with falling open interest is not bullish enthusiasm, it is retreat. In past silver dislocations, this exact configuration preceded 18 to 25% repricing phases over 3 to 6 weeks. Not because the public rushed in, but because insiders rushed out. They saw the imbalance before it reached the screen. At the same time, the physical market stopped playing along. For months, paper upticks were paired with premium compression of 5 to 10%, the telltale signature of an arbitrage delusion. Paper said, higher. Physical said, not real. Now that compression has stalled, paper rises and physical refuses to cheapen. That is not coincidence. That is fracture. Correlation collapsed next. Silver detached from oil, from equities, from every convenient macro excuse. Days of plus 2.5% to plus 3.8% appeared without justification that fit the official narrative. When price moves without permission from the story is no longer in control. This is where they hope you stop looking. They want you focused on headlines. They want you distracted by noise. They want you believing this is just another cycle. It isn't. Silver is not a normal commodity. It is a monetary metal trapped inside a derivative cage. For decades, that cage worked because trust worked, because participants believed claims were interchangeable with ounces, because rehypothecation was invisible. That trust is eroding. When even 15 to 20% of synthetic exposure exits a market built on leverage, price does not drift. It snaps. Not immediately. First, it compresses. Pullbacks shrink to 1.5 to 2.0%. Volume stays artificially calm within plot 9% of baseline. Volatility tightens another 5 to 7%. This is not peace. This is pressure being stored. Controlled markets punish impatience. Releasing markets punish denial. And denial is everywhere. Most investors will misread this because they are trained to react after 5 to 7% moves, not before them. By the time silver feels obvious, the mechanism has already shifted. The insiders are lighter. The exits are crowded. The illusion is already cracking. This is not about upside. This is about exposure. This is not about profit. This is about survival inside a system that cannot reconcile paper promises with physical limits. They will not announce this. They will not warn you. They will not admit it until after the fact. Because admitting it means admitting that price discovery was never real. This is not a glitch. This is not volatility. This is a physical truth forcing itself through a paper lie. And it is unavoidable. What comes next is not a question of if, but how fast. When suppression weakens, repricing accelerates faster than positioning can adjust. That is how squeezes begin. That is how defaults form. That is how confidence dies. If you are still waiting for permission to act, you are already behind the curve that matters. Protect what you can verify, question what you cannot audit, and stop trusting a system that only works as long as you don't ask where the metal actually is. This is the first phase, and it will not be the last. What you're watching now is the phase where the system pretends nothing is wrong. This is the most dangerous moment, because the illusion still holds, Comex prices still print, ETFs still trade, statements still settle. But beneath that surface, the arithmetic no longer works. For years, the silver market relied on rehypothecation to function. One bar pledged, then pledged again, until a single ounce quietly supported 40, 60, sometimes over 100 synthetic claims. This was never hidden. It was just buried in footnotes and clearing language and settlement clauses no retail investor ever reads. The establishment calls this liquidity. Forensic analysts call it leverage stacked on faith. And faith is what is breaking. Over the past 10-14 days, we have seen abnormal arbitrage behavior between paper contracts and physical availability. When arbitrage is healthy, price differences close quickly. Recently, they haven't. Gaps of 3 or 6% have persisted longer than statistical norms allow. That does not happen in balanced markets. It happens when inventory is spoken for. This is why physical premiums matter more than spot price. Spot can lie, premiums cannot. When premiums refuse to fall while paper price rises, the message is simple. Metal is not being released into the market. It is being withheld, either because holders do not trust settlement or because they understand what comes next. This is where they lose control of the narrative. Banks will tell you inventories are adequate. Exchanges will tell you delivery ratios are normal. Regulators will tell you there is no stress. But numbers do not care about reassurance. Registered silver inventories have been drawn down repeatedly, while open interest still represents multiples of deliverable supply. Even conservative estimates place effective coverage ratios below 20 to 25%. That means for every 5 claims, only one can realistically be satisfied without delay. That is not a market. That is a confidence game. And confidence games end the same way every time, with a rush to the door. You can already see the behavior change. Delivery requests are rising relative to historical baselines. Not exploding, yet, but enough to matter. A 2 to 3% shift in delivery intent inside a system built on leverage is not incremental. It is exponential, because it forces the system to choose who gets metal and who gets cash. Cash settlement is where illusions go to die. Because once participants accept cash instead of metal, the question is no longer what is silver worth. The question becomes, why was metal unavailable at any price? This is why suppression is exiting rather than flipping long. Insiders understand that being synthetically short a thinning market is asymmetric risk. You gain pennies, you lose everything. When even 10-15% of those positions unwind, price behavior changes immediately, and it is changing now. Look at the tape. Intraday sell-offs of 1.2-1.8% are being absorbed within hours. Closes print flat or green. That is not retail buying dips. That is inventory being defended by those who cannot afford to lose it. In prior silver stress events, when this pattern repeated 3 to 4 times inside 2 weeks, the following move was sharp and disorderly. They call that volatility. It isn't. It is inventory stress. This is why correlation failure matters so much. When silver rises 2 to 3% on days when the dollar is strong, equities are mixed, and oil is flat or down, the macro excuse collapses. What remains is internal imbalance. An imbalance does not negotiate. At this stage, the system's primary goal is time, delay, confusion, narrative control. They need participants calm while positions are adjusted quietly. They need retail believing this is normal while professionals reduce exposure. That is the playbook. It has been used before. In 2008, liquidity evaporated. In 2020, markets paused. In every case, the warning signs were visible weeks earlier, but only to those looking at structure instead of stories. This is the same pattern expressed through silver, a market where paper claims dwarf physical reality cannot unwind gently. It can only compress until something gives. Either confidence returns or it collapses. And confidence does not return when questions about delivery remain unanswered. You're not being shown this on mainstream channels because it challenges the foundation of modern price discovery. If silver is not freely available at posted prices, then posted prices are not real. And if posted prices are not real, then the entire derivative complex rests on trust alone. Trust is evaporating. This is why the language is changing quietly. Watch how often officials say orderly, stable, functioning. Those words appear only when something is at risk of becoming disorderly, unstable, and dysfunctional. They are not talking to you. They are talking to each other. This is not fear-mongering. This is arithmetic. When leverage meets limits, repricing is not optional. It is inevitable. And the longer it is delayed, the sharper it becomes. This is still the early phase, the phase where exits are possible without headlines, the phase where the illusion still works, barely. But illusions fail suddenly, and when this one does, silver will not move because buyers appear. It will move because the system can no longer pretend. What comes after illusion is exposure. And exposure is what the system fears most, because once confidence cracks, it cannot be patched with liquidity injections, speeches, or regulatory language. Confidence only exists as long as participants believe claims will be honored. The moment that belief weakens, every synthetic structure built on top of it becomes unstable. Silver sits at the center of that instability. Unlike equities, silver cannot be printed. Unlike bonds, it cannot be rolled indefinitely. Unlike currencies, it cannot be created by decree. It exists or it doesn't. That physical finality is why silver has always been treated as a problem inside financial systems. It exposes leverage. It exposes rehypothecation. It exposes the difference between ownership and entitlement. And that difference is becoming visible again. Consider the math they don't want discussed. Paper silver markets routinely operate with effective leverage ratios estimated between 30x and 100x, depending on contract structure, ETF composition, and unallocated accounts. Even conservative assumptions put the system at 20x. That means a 5% shift in delivery preference does not create stress. It creates crisis. You're watching the early stages of that shift. Delivery intent is rising slowly, deliberately. Participants are not panicking yet. They are testing. They are probing settlement timelines. They are asking quiet questions through behavior rather than headlines. And the answers they are getting are not reassuring. Delays lengthen. Substitution clauses matter more. Cash settlement becomes easier than metal. That is never a sign of health. This is where the establishment changes language. Force majeure. Extraordinary circumstances. Temporary dislocations. These phrases are not designed for you. They are designed to legally protect a system that knows it cannot meet simultaneous claims. History is clear on this point. Whenever a commodity market transitions from physical confidence to paper dominance, the unwind is never smooth. Gold experienced it in 1968. Oil experienced it in 1973. Even nickel showed a glimpse in 2022 when leverage met reality and trading had to be halted to prevent cascading failure. Silver has been insulated from that moment only because trust lasted longer. That trust is eroding. You can see it in who is acting first. It is not retail. It is not social media traders. It is hedgers, refiners, industrial users, and institutional participants reducing synthetic exposure while maintaining or increasing physical optionality. That behavior tells you everything. They are not chasing price. They are avoiding risk, and avoidance always precedes repricing. Short-term forecasts miss this entirely. Analysts argue about $2 moves, about resistance at $28 or $30, about Fibonacci levels and momentum oscillators. Those tools assume continuity. They assume the market structure remains intact. But structure is exactly what is breaking. When structure breaks, levels do not matter. Liquidity does, inventory does, trust does. In the next 1 to 4 weeks, the most likely outcome is not a vertical spike. It is continued compression, choppy advances, sudden pullbacks of 1-2% that are absorbed faster each time. This frustrates late traders and calms observers. That calm is artificial, because beneath it, exposure continues to exit. The real risk sits just beyond that window. If geopolitical stress intensifies, if energy markets tighten further, if monetary expectations shift even marginally, the pressure on synthetic metals accelerates. It does not require a crisis. It requires a catalyst that reminds participants why metal exists in the first place. And those catalysts are not hypothetical. Debt issuance continues to rise. Real rates remain unstable. Fiscal credibility is questioned openly. In that environment, even a 5 to 10% reallocation out of paper promises into physical reality overwhelms a market built on leverage. That is why silver behaves differently than gold in these phases. Gold absorbs fear. Silver exposes imbalance. Gold moves first. Silver moves harder. That hardness is what they fear. Because silver repricing does not stay isolated. It leaks. It questions industrial supply chains. It challenges inflation narratives. It forces uncomfortable questions about reserves, inventories, and settlement mechanisms. Questions they cannot answer publicly, so they delay, they stretch, they substitute, they reassure, but arithmetic does not negotiate. When enough participants decide that holding a claim is riskier than holding metal, repricing accelerates beyond control. That is not ideology, that is mechanics. And mechanics always win. You are being conditioned to think this is noise, to believe this is just another cycle, to wait for confirmation from institutions whose incentives depend on your patience. That patience is the resource they need most. Once it is gone, the adjustment becomes unavoidable. This phase still allows time, not comfort, time. Time to reassess exposure, time to question assumptions, time to understand that price is not the same as availability. Because when availability becomes the question, price becomes secondary. That is the phase approaching. And when it arrives, the narrative will flip overnight. The same voices telling you silver is well supplied will explain why shortages were unexpected. The same institutions dismissing stress will frame cash settlement as efficient. That is how denial ends, not with an apology, with a redefinition. This is not about belief, this is about structure, and the structure is bending. The final stage is never announced. It arrives disguised as normality. Prices still print, markets still open, commentators still argue over decimals, but underneath, the system has already chosen who will be protected and who will be converted into collateral damage. This is where silver stops behaving like an asset and starts behaving like a referendum. a referendum on trust, on settlement, on whether ownership means possession or permission. The uncomfortable reality is this: the modern financial system does not require most people to be wrong. It only requires them to be patient, to wait, to assume continuity, to believe tomorrow will look like yesterday. That assumption is breaking. When leverage reaches 30x, 50x, even 100x, the system can tolerate price volatility. What it cannot tolerate is doubt. Doubt is the catalyst they cannot hedge. And doubt is spreading quietly, structurally, through behavior rather than headlines. You see it in how institutions talk around silver instead of about it. You see it in how delivery clauses grow longer. You see it in how cash equivalent becomes a feature instead of a last resort. Those are not improvements. Those are escape hatches. In every historical unwind, the same pattern appears. First denial, then delay, then redefinition. What used to be a promise becomes an option. What used to be delivery becomes settlement. What used to be ownership becomes exposure. Silver is approaching that line. If even 5 to 7% of outstanding claims demand physical confirmation simultaneously, the system faces a choice it cannot win publicly. Honor delivery and expose leverage, or offer cash and expose illusion. Either outcome breaks confidence. And once confidence breaks, price becomes irrelevant. Availability becomes everything. This is why the final phase is fast. For weeks, nothing happens. Then in days, everything happens. Spreads gap, quotes thin, technical issues appear, trading halts are discussed, not to protect investors, but to protect plumbing. By the time the public realizes something has changed, the repricing has already occurred. That repricing will not be explained as failure. It will be explained as necessity. They will say it was orderly. They will say it was temporary. They will say it was unforeseen. It never is. The math was always there. The leverage was always visible. The only variable was when enough participants stopped pretending not to see it. That moment is approaching. This is not a prediction. This is trajectory. You do not need silver to go to a specific number for this to matter. $30, $35, $50, those are distractions. Levels are for traders. Structure is for survivors. What matters is whether price discovery can continue without confidence. Right now, it cannot. That is why suppression is leaving instead of doubling down. That is why exposure is being reduced instead of rolled. That is why silence is louder than commentary. And that is why waiting for confirmation is the worst possible strategy. Confirmation arrives after repricing, not before it. This is the moment where the roles separate. Those who understand mechanism versus those who consume narrative. Those who protect what they can verify versus those who trust what they cannot audit. This is not about being bullish. This is about being realistic. If your silver exists only as a line item, a promise, or a pooled claim, you are trusting a system whose primary objective is continuity, not truth. Continuity can be suspended. Truth cannot. When systems reset, they do not ask for permission. They do not reward patience. They do not compensate loyalty. They preserve themselves. Your job is not to predict the headline. Your job is to understand the mechanism. Silver is not rising. It is being released. And release phases do not slow down to let everyone catch up. Protect what you can touch. Question what you cannot inspect. Do not confuse price with availability. Because when this phase ends, the question will not be, why did silver go up? The question will be, why didn't anyone warn us? This was the warning.